Most traders don't lose money because they don't know entries. They don't lose because they don't know indicators. And they don't lose because the market is complicated. They lose because they don't know one simple thing. Where the market is actually going, a trader who understands direction can win even with weak entries. But a trader who does not understand direction will lose even with perfect entries. Today, I'm going to break down the simplest, clearest, and most practical way to know market direction, the real way. Not the YouTube shortcut, not the indicator guesswork, but the actual price behavior method professional traders use. By the end of this video, you will understand what trend structure really means, how impulse and correction reveal the next move, how to read price narrative without indicators, and the most important part, when not to enter, even when everything looks perfect. Let's begin. Part 1. Market direction is not what you think most beginners think market direction means. Green candles equals up, red candles equals down or RSI below or above equals direction, or some EMI cross equals direction no. Those are opinions, not direction. Real direction is revealed by structure. The footprints of liquidity, the path of least resistance that price is currently following. If you understand structure, you don't chase moves. You don't guess. You don't pray during drawdown. You simply read price like a map, calmly and confidently. But the question is, what is structure? Let's break it down, step by step. Part 2. Trend structure, the real foundation. Trend structure is the skeleton of the market. If you strip away candles, remove indicators, delete volume, what remains is the sequence of highs and lows. That sequence is the truth. A market can only be in one of three conditions. 1. Uptrend, higher highs, higher lows. 2. Downtrend, lower lows, lower highs. 3. Range, equal highs, equal lows, sideways. Let's decode each one. Uptrend, this is when the market is slowly climbing upward like a staircase. Easy meaning higher, high. Every time price goes up, it goes higher than the previous high. Example, first it touches 100, then next time 105, then 110. Each high is bigger. Higher low. When price drops, it doesn't drop as low as before. Example, earlier the low was 90. Now the low is 95. Price refuses to fall deeper. Together, these two mean buyers are strong. They are pushing the market up again and again. If you try to sell in an uptrend, you are basically standing in front of a car that is moving uphill. No matter what, it will hit you. Downtrend, market going down. This is when the market is falling like a staircase in reverse. Easy meaning lower low. Each drop goes lower than the previous drop. Example, first drop hits 100, next drop hits 92, next 85. Each low is worse. Lower high. When the market pulls back up, it doesn't go as high as before. Example, earlier it bounced to 110. Now only to 102. Buyers are weakening. This means sellers are controlling the market. If you buy in a downtrend, you're trying to catch a falling knife, and usually your hand gets cut. Range market going sideways. This is when the market is stuck between two levels. Simple meaning, price keeps bouncing between a top level and a bottom. Levelites not going up or down properly. Buyers and sellers are fighting. But no one is winning. Market moves slow and confusing. It looks calm from outside, but inside, liquidity is building on both sides. Ranges are traps for beginners. People enter randomly from inside the box, and the market takes their money when it finally breaks out. Professionals wait outside the range. Beginners get chopped inside the range. Part 3. The secret. Structure breaks. Now here is where professional traders get direction from. The break of structure. When price fails to maintain higher high, higher low, or lower low, lower high, and breaks the opposite side, direction is changing. Example: market is making higher, higher, gives, higher low, gives, higher high, gives. Higher low, suddenly price falls and breaks the previous higher low. That break is the death of the uptrend. A new downtrend is preparing. Beginners ignore this break. They still buy because they think uptrend is alive. Professionals immediately switch. DIRECTION BOS is the earliest warning that the market has changed its mind. Top part 4. Impulse versus correction, the heart of direction. Most traders lose because they confuse impulse and correction. Let me simplify it. Impulse, strong, sharp. Fast movement, clear pressure, long candles, very. Little pullback. Direction shows clear dominance. Emotion present in the market temples equals the real move. Market shows its intention through impulse. Correction: slow, choppy movement, weak candles, small ranges, time. Passes, but price does not go far. Market is taking a breath. Trap is for a main. Correction equals a pause before continuation or reversal. Now here is the formula. Impulses reveal direction. Corrections reveal the entry. When you don't understand this, you will buy inside a correction thinking it's an impulse, sell inside a correction thinking it's a breakout. Get trapped, lose. Repeat cycle. But once you master impulse versus correction, you will always know exactly where price is heading next. Part 5. How to identify real impulse move. Say real impulse move has 3 characteristics. 1. Speed the candles, move quickly. No hesitation. Momentum is clear. 2. Strength candles close near their highs in bullish or lows in bearish. No wicks showing rejection. Clean movement. 3. Break structure. This is the most important. A real impulse breaks a key high or low if you see candles moving fast but they do not break previous structure. That is not an impulse. That is noise. Part 6. How to identify. REAL corrections. Corrections is the opposite. Small candles, price moves sideways or slowly against the trend. Trend line breaks, fail. Structure stays intact. Market looks boring. This is where most beginners enter too early. They confuse low volume correction for a reversal. Professionals love these corrections because they create perfect trend continuation. Entries. Part 7. Combining structure plus impulse plus correction. This is the real trick to knowing. Direction. 1. Identify the current structure. 2. Watch which side gets broken. 3. Track impulse to see where pressure is. 4. Wait for correction to enter. This gives you clean direction, high probability, minimum confusion, stress-free entries. Very small stop loss. Listen carefully. This part is the quiet backbone of trading. The part most traders skip because it's boring, and the part that actually wins money. You must learn not only when to press the button, but, even more importantly, when to do nothing. The market will offer you setups that look like perfection, but more often than not, they are traps dressed as opportunities. Picture a busy intersection. Just because the light turns green for a second does not mean a bus won't come barreling through on the wrong side. Patience here is a protective skill. Do not enter simply because a signal flashed. Do not enter because someone said, "This is it." And do not enter because fear of missing out. That loud, small voice screams. The first rule, then, is simple to say and hard to apply. Do not enter during a correction. A correction is the market taking a breath, a temporary pause in the larger move. It is slow, it is choppy, it is filled with mixed candles and with hesitation. When you see price move against the dominant direction in small, nervy steps, that is a correction. Your brain wants to act. Because corrections feel like discounts, they feel like bargains. But most of the time, discounts are a setup for the trend to continue and for you to be shaken out. Entering inside a correction is like buying shoes in the middle of a hurricane because the price tag looks good. Wait for the next impulse. That is when the market shows intent again. The impulse is the loud, fast, confident shove, the price that moves honestly and breaks structure. Trade with that energy, not against the market's breath. Second, do not enter immediately after a huge impulse. When a powerful move rips through the market, retail traders see the price and rush in believing the move will never stop. They pile in at the immediate top, and then the smart money takes profits. Massive impulses often trigger profit-taking and sharp retracements. The market leaves a warning: exhaustion. You will feel the temptation to chase, to double down. To prove you missed the trade but will catch the end, resist, allow the market to correct, and to show a clean area where structure remains intact and the trend can resume. Your best entries arrive after that correction, when the market has digested the move, not while it is still vomiting out its emotions. Third, do not trade inside ranges unless you have a razor-sharp plan and the experience to execute it. Ranges are neutral ground. Both sides camp there and fight. Orders cluster at the extremes. False breakouts abound. Beginners mistake sideways movement for calm, and calm in the market is actually a minefield. If you must trade a range, keep your risk tiny and accept that you are speculating on crowd behavior. But for most traders, the range should be a highlighted reminder to step back, to breathe, and to wait for a true structure break. Fourth, do not trust indicators as your primary reason for entry. Indicators are tools, not leaders. They exist to show what has already happened, to summarize the past. The market, however, moves on price and structure. An EMA cross may make a pretty line, but it will not save you from a structural failure. If your entry relies solely on numbers calculated from old prices, you are building on a photograph instead of the living scene. Use indicators sparingly as confirmatory whispers, not as shouted commands. Finally, never enter without recognizing that structure has been violated or confirmed. No break of structure, no entry. It's that clear. Break of structure is your earliest warning that the market's direction has shifted. Treat it with the respect it deserves. If the market has not given you that clear sign, step out. This is not hesitation. It is discipline. It separates traders who survive from traders who parrot strategies. Now picture a real market, not a textbook chart, a breathing, noisy market. Imagine we begin in an uptrend, a simple staircase of higher highs and higher lows, each swing higher, each dip shallower. You watch quietly. You do not act impulsively. Then one day you see a large bearish candle, bold and unsettling. Beginners panic and scream, "Trend over." They sell quickly because the red looks loud and honest. But professionals lean back. They check the location of that candle. Is it inside the previous higher-low area? Has the structure actually been broken? If the candle sits within the previous swing, structure often remains intact. What you are watching is emotion, not a decision. The market can produce ugly candles that are merely noise. And those candles are there to scare the impatient into bad choices. Observe the next sessions: slow, bearish, dragging, choppy sideways. That is correction. It is weak. It is testing the resolve of the buyers. Professionals prepare to buy into that weakness, not at the first red, but at the moment the market resumes its upward impulse. Then, with a single clean impulsive bullish candle that breaks the previous high and closes with conviction, the market tells you the trend is continuing. That is the moment you act. The entry is not a gamble. It is a measured step into a movement the market already committed to. But the story does not end there. The market will change its mind again, subtly, with a break of structure. When the price finally drops and falls beneath a prior higher low, you must pivot your thinking. The same discipline that stopped you from selling into strength now tells you to prepare for a shift. You do not flip instantly. You watch the market test new levels. If sellers take control and produce lower lows and lower highs, the trend has transformed. You adapt because the market is a teacher that rewards flexibility to know direction in real time. You must follow a simple, elegant sequence, and I will describe it so plainly that you can perform it in your head while the candles are still forming. First, always zoom out. The human brain loves the close-up because it is dramatic, but the zoomed-out view gives you context. A 5-minute fight may be a whisper in the daily chart. Begin by identifying the dominant structure on the higher time frame. Is the market making higher highs and higher lows, lower lows and lower highs, or is it meandering sideways? Mark those significant swing points visually. They are your reference. Second, mark the high and the low that define that trend. These are not guesses. They are the lines where the market has spoken clearly. Third, watch for impulse. Wait for a candle or a series of candles that show speed and strength, and that break a prior structure point. That impulse is the market's declaration. Fourth, avoid entering during the impulse. Instead, wait for the correction. Corrections are the market's invitation. They show you a place where risk becomes manageable, where stops can be tight, and where reward to risk improves. When the correction ends and the market produces a confirming, impulsive continuation, that is your entry zone. You trade the pattern of structure, impulse, correction, not the emotion of the moment, step by step when a trade setup appears. Go silently through these checks. Does the higher time frame support this direction? Is the structure intact or broken? Has an impulse occurred that favors one side? Am I attempting to buy into a correction, or am I entering a fresh continuation after a correction? Where will I place my stop so that the trade is invalidated if I am wrong? Where is the logical target based on the market structure and liquidity? If any one of those answers fails, do not trade. The market has infinite possibilities. Your capital is finite. Protect it first, profit will follow. Beyond the technical steps, there is a deeper psychological layer that influences every tick. Remember that impulse equals emotion and correction equals manipulation. The big players, the ones who move markets, do not buy slowly. They buy decisively and aggressively, producing impulses. They do not leave price to drift without intent. During corrections, they test, often shaking out weak hands. That shakeout is the market's cruel but honest way of separating the emotional from the disciplined. If you allow your emotions to drive entries, if fear or greed pushes you, you will be the weak hand the market is designed to expel. Instead, cultivate patience, curiosity, and humility. Watch price as if you are an anthropologist studying a tribe. Notice the patterns of behavior, the rituals of buying and selling, the points where the tribe consistently acts in a particular way. When you view the market like people making decisions rather than a machine with hidden rules, you begin to anticipate rather than react. Now translate this into habit. Each trading day, before you press enter, run a mini checklist in your mind. Not a checklist of technical indicators, but of structure and psychology. Tell yourself, I will not enter inside corrections. I will not chase impulses. I will place stops beyond invalidation points. I will risk only what I can afford to lose. This little internal dialogue creates a behavioral architecture that prevents impulsive entries. Over time, the habit becomes automatic. Your body learns to wait, and your account learns to grow. There is practical muscle in the discipline too. Use smaller position sizes when you are uncertain, but prefer zero size to a bad size. Trade less, but trade cleaner. When you act only on high probability patterns, structure confirmed. Impulse clear, correction complete, your trade size can be meaningful and your risk can be controlled. On the other hand, if you trade every fuzzy signal, your position sizing will need to be tiny and your results noisy. Professionals choose clarity over busyness because consistency compounds. Finally, let us summarize the mindset you must carry like a trader's creed. Market direction is not a guess. It is the logical inference you draw from structure and impulse. Corrections are not failures. They are opportunities to enter properly or traps to avoid. Ranges are tests of patience. Indicators are tools, not masters. Protect capital by refusing to trade on insufficient evidence. Trade when the market has shown you both its intent and a reasonable entry point. Build your decisions on the market's language of highs and lows, on impulsive energy, on clear breaks of structure. And always remember, the market is a conversation between millions of participants. Your job is to listen, not to shout. Your best trades will come from silence, from restraint, from the calm moment when the market points the way and you, ready and patient, finally step in. And with that, we close today's session. If you've listened all the way to the end, thank you, genuinely. Your time, your focus. Your commitment to understanding the truth behind market direction means you're already far ahead of the average trader. Most people chase signals, but you're learning structure, psychology, and real market behavior, the things that actually change results. In the next video, we're going even deeper. We'll break down another crucial piece of the trading puzzle, the kind of lesson that quietly upgrades your entire strategy and finally makes everything click. If today's video opened your eyes, the next one will open the door, so stay ready. Stay disciplined, and I'll see you in the next important video.